On the Investopedia Express this week, record highs everywhere you look. It's the revenge of the meme stocks. Yeah, they're back. Public companies are binging on Bitcoin. We drop in with Ryan Dietrich of the Carson Group for a few good minutes to discuss it all. It's the pros versus the Joes in the stock picking contest. We'll tell you who's winning right now and the Investopedia indicator and what to watch this week. If you're riding the rails to investing success, this train goes express. Welcome back and welcome aboard. I'm Caleb Silver, the editor-in-chief of Investopedia. We are live from the New York Stock Exchange like we are every single Monday, the Investopedia Express live on streaming platforms, plus on demand, wherever you get your podcast across the networks here. Again, record highs across the market. Stocks a little softer today. Let's do a little market check and see what's going on. Stocks dropping a little bit from their record highs, closing out last week before the July 4th holiday. A lot of that may be due to the uncertainty facing us this July 9th, just a couple of days away. That's when the reciprocal tariff deadline ends. And we did hear from the President and Treasury Secretary over the weekend that unless there are deals, they're going to announce a 10% across-the-board tariff on our biggest trading partners. That's got markets backing off a little bit this morning. But before all that, going into the holiday weekend, the air got a little thin around here because there were record highs everywhere you look. Check it out. Stocks all-time highs when you're talking about the S&P 500, talking about the Nas, home prices, all-time highs. Bitcoin hit an all-time high. We'll get into how public companies are stuffing their treasuries with Bitcoin in just a little bit. Money supply also at an all-time high. Yeah, we're spending a lot. We're printing a lot of money to keep this economic experiment going right now. And the national debt at an all-time high, and it's just going to keep getting higher, especially with the signing and passage of the big, beautiful tax bill that happened on July 4th as expected. So we got new tax law, or the extension of the 2017 tax cuts facing our way, but we also have a ton of news coming our way with the tariff deadline coming up just a couple of days away on Wednesday. We saw a small deal with Vietnam before the holiday weekend, but the big deals, the ones we care about the most, are with the United States' biggest trading partners. We're talking about China. We are talking about Canada. That doesn't look like it's going very well at the moment right now, but also Japan, very big deal there. And Europe, not exactly happy with some of the terms that they've been presented with. So a lot to come in the next couple of days. But if you look across the markets, investors were not paying attention or caring too much about it going into the big weekend. Stocks at all-time highs, sectors ripping to all-time highs. And what has that created? That creates an overbought condition. Check this chart out from our good friends at Bespoke Investments. Overbought almost everywhere you look, going up from the technology sector all the way up through materials. You're seeing sectors overbought. We've swung a little too far on the pendulum the other way. And when we get excited as investors, we just keep buying. And basically, we have bought every sector until it's basically overbought. The real estate sector, healthcare sector, and utilities, not on the overbought list yet, but we've been pushing asset prices up higher. Stocks, talking about crypto as well, but overbought conditions everywhere. And usually that leads to a little bit of softness after so much irrational exuberance. But when you look at the asset classes so far this year, we're going to look at a chart from Charlie Bellello. Great chart here. Terrible chart to read on this screen, but just trust me, if all that green you see, especially to the far right, that is every asset class but commodities streaking to highs and in the green this year. So nearly every asset class, we're talking about stocks, we're talking about gold, we're talking about crypto, we're talking about small stocks as well. All stocks sort of ripping higher in the green this year. I don't think a lot of people had that on their bingo cards going into this year. But when you have enthusiasm and you have a trend like this one, they say right around here on the New York Stock Exchange and all over Wall Street, the trend is your friend. So if you've been fighting the trend of a rise in prices for stocks, basically, and all risky assets, you have missed out on a rally because stocks have come all the way back from those early April lows to strike new highs yet again for the S&P 500. And guess what happens when that happens? A little more irrational exuberance. This is something we should have expected to come down the pipe, but meme stock mania is back. It's meme stock mania 3.0. And check out some of these stats. Smart story in the Wall Street Journal over the weekend about meme stocks. Since April 8th, the market bottom, 14 companies from the Russell 3000 have more than tripled in value. Those are the little stocks, right? Of those 14, 10 are unprofitable. profitable, according to our friends at Bespoke Investment Group. By late June, 858 unprofitable Russell 3000 companies posted average gains of 36%, outperforming profitable companies. Yeah, investors are favoring the non-profitable startup companies, low on revenue, high on expectations, but they're bidding them too high. Look at some of these stocks with some of these gains so far this year. Ava Technologies, that company is not profitable. That stock's up 400%. Very busy stock in the Reddits and the subreddits, and you see a lot of individual investors piling into that one on momentum. Syngene Technologies, again, not profitable. They did $100 million in revenue last year, but losing money, and that stock's up 230%, a very popular meme stock among investors. Avis Budget Car Group, yeah, Avis. I'm talking about Avis. That stock up 162%. If you were around in 2021 during meme stock mania, Avis was one of those stocks, along with Hertz, that day traders like to use as a chew toy. That stock up 162%, not because of results, just because of the mania surrounding it. And Carvana, one of the top performing stocks of the last couple of years, that stock's up 114% so far this year. Who's buying cars? I know there was a lot of car buying in March and April heading into potential tariffs on foreign imports, but Carvana is just one of those meme stocks that day traders love to play around with. And guess what? That stock up over 100% this year. So when you get this exuberance, when you get this enthusiasm, when you get people buying into the trend and just thinking, if I'm not buying, I don't know what I'm doing around here, then you get a lot of meme stock mania happening. And you get a lot of risky assets popping to the top here, bubbling up, and that's exactly what we've seen. So be very careful, because these never end well. If you can time it right, good for you. If you want to play around with a small position in your portfolio, have some fun with it. These don't look like long-term investments unless you're smart about it and dollar cost averaging your way in. But as we say, the trend is your friend. Momentum moving in the right direction, kind of at an odd time of year, and given all the headline news, what to make of it? Well, we're going to have a few good minutes with our friend Ryan Dietrich of the Carson Group. He's dropping in. I cite Ryan so much on the podcast and in all my research. He should co-host the podcast with me, but he's got an amazing podcast with his partner over at the Carson Group, Sonia Varghese, that you should be paying attention to as well. So let's bring on Ryan Dietrich. Drop on in, my friend. Good to see you, my friend. Thank you for joining the Express again. I think you should be co-hosting this because I cite you all the time, but it's good to see your face and have you on the Express live from the New York Stock Exchange.
Hey, I appreciate it, Caleb. I listen all the time. It's going to be tough to follow. You had Sam last week. Sam was awesome, but I'm honored to get to join you again. And, I'm in New York on Thursday. I'm going to be at that CMT thing. So you need to come to New York Thursday night at the CMT thing. I'll get you the details. It'll be fun.
Yeah, our buddy Jay here told me all about it. The CMT, the Charter Market Technicians.
There you go.
This is where the chartists get together every few months here in New York City or wherever they happen to be, and they get busy with the charts and the trends and the technical analysis. These are some of the smartest people I know. Ryan, I'm excited to see you there this week. But let's get to some of your research, because I've just been eating it up like oatmeal all weekend long here. You called this a few weeks ago, actually, I think about a month ago, the Rocky Balboa market. Never got me down, Creed, and we never did get all the way down. What inspired that comparison to you, and where are we now?
Well, you're right. There's so many ways to look at this. I mean, this year has been one of the best years we've ever seen in terms of what happens the day after a down day, and that's kind of where I got the Rocky Balboa. Yes, you've got your April 9th, 9.5% rally, after a down day. That skews that to a degree. But we've been seeing this. I mean, we've been seeing this all year, really, that this market bounces back. We had the 2 terrible days of Liberation Day, yes, but we continue to see really positive things. One thing I thought was kind of interesting this year so far, we just had this huge second quarter. We know that. When you're up between 5 and 10% at the midpoint of the year, like we are right now this year, up about 5 or 6% or so at the midpoint of the year, the rest of the year, Caleb, is interesting. It's up 13 out of 15 times with better than average returns. There's lots of other stuff we can look at, but I call it kind of that sweet spot. Like 87 was up a whole bunch, right? And we know that rubber band would stretch. Well, the worst second halves of the year, normally after the worst first halves of the year, it's kind of how it plays out. So the fact we're kind of like porridge right in the middle here, a little bit better than average, we think, hey, that's another reason to continue to think this is a bull market, a global bull market we can get into if you want, that continues to be positive.
Yeah, it is a global bull market. There's a bull market pretty much running all across the globe. And even before the S&P 500 bounced back and the U.S. stocks bounced back, top markets in the world, as you know, were Poland,
Yep.
Mexico, Chile, right? It was a very strange. Brazil was in that list as well. A lot of the companies, and you think a lot of the companies that would have had tariff issues with the U.S. were some of the best performing markets in the world. Yet the United States was lagging. I think some of that was the headline
Mhm.
list, Ryan. But what I love about your research is that there is so much noise in the market right now. We've had 6 months of headlines. It feels like 6 years worth of headlines here. But the kind of market does what the market does. And when you see this type of momentum and people, I wouldn't say ignoring the headlines, but this relentless bid into
Yep.
stocks, especially into the growth part of the market, what does that tell you as a strategist?
Yeah, I know you're sharing it now. The idea of a slingshot. I've shared this theme a lot. They got the Rocky Balboa theme, the theme of a ball under the water. Once you let it go, it keeps going higher and faster than you think. And the idea of a slingshot, right? We had a negative first quarter on the S&P 500. We all know that. Well, historically, the first quarter of a post-election year, Caleb, is not that weak. Or I'm sorry, it's pretty weak overall. The first quarter after a 20% gain historically is pretty weak. Oh, the first quarter last 20 years is the weakest quarter by far. So it wasn't shocking to us when we looked around, this time 6, 7 months ago, and all these bears were becoming bullish. With okay, it might be time to shake the tree a little bit. And yes, the tariffs and all that stuff did it. But I think we would have had some other reason probably to shake the tree and get rid of some of the Johnny Come Lately bulls. And then we had the 10% rally in the second quarter. That's what we're sharing on the screen now. And when you have a negative first quarter and then a 10% second quarter, the third quarter has never been lower. The fourth quarter has never been lower. And the rest of the year is up 16% on average. No, we're not calling for a 16% rally the second half of this year, but I think it's really important, like you just said, there's some of the idea of these momentum stocks and some of these previous leaders. I mean, we really like momentum ETFs, right? Like MTUM. We've got a pretty good allocation of that with the money we run. We think those momentum areas are going to continue to do really well the second half of this year. They did great the first half of the year. We think it's going to continue.
Yeah. Next comment there from some of our listeners, Kal Fazal. Yes, getting into it. So when you talked about some of the momentum plays in the market, and I was going through a chart earlier from our good friends at Bespoke about where sectors were overbought, and basically from technology all the way up, we are in overbought conditions.
Yeah.
Maybe not consumer discretionary because there's concerns about spending and how much resiliency we'll have. There's that chart again. But from materials on down, industrials, energy sector, staples, talking about overbought conditions. So as investors, we always swing a little too far in one direction, whether it's too negative or too positive. But do you think these overbought conditions are going to continue? Because now we have the passage of the tax legislation, and we're going to get some news on tariffs later on this week. Who knows what that will be? But so far, more smoke than fire. Those are the headlines that are surrounding and sort of hanging over the market. But you like to look at price. You do the technical analysis and the fundamental analysis, which is why I love your research so much. You bring them all together. Just look at price with me for just a second. Are you concerned about any of these sectors being overbought and that affecting the trend continuing?
Not really. Near term, you could say maybe it's time for some digestion. I mean, that would be perfectly normal. But, historically, super overbought is like usually a pretty good signal, right? The S&P was just up over 20% in 2 months. We just hit that 2 months off the bear market, near bear market lows there in April. And only 5 other times in history were you up 20% in 2 months. Now, let's see if I can remember these off the top of my head. Off the lows in 75, 82, there was a late 1998, there was of April or May of 2009. And then again, I think it was May of 2020. And then we just had that again in June of this year. So up 20% in 2 months, you might say, oh my goodness, this is so overbought. It can't go any further. But history, Caleb, would say, it absolutely can when you become extremely overbought. And we just look what happened last week. I mean, technology all-time high, communication services all-time high, industrials, and financials. To me, to see those cyclical areas leading, yeah, they might take a little break, a little pause here. But I think from a portfolio point of view, the way we look at the world, we're overweight those cyclical areas, and we think they're going to continue to do pretty good the second half of this year as the economy doesn't have a recession. Maybe the Fed cuts a little bit more. Maybe we get some good news as it pertains to tariffs. And again, just it's a global bull market. The lifeblood of a bull market. You've had a lot of guests say this. I'm going to say it too. Is passing that baton around. U.S. didn't do all that well the first half of the year. I know it sounds wild because it's been a crazy run, but the U.S. didn't. It underperformed. Right? India, U.S., and Taiwan are like the 3 weakest countries. Like 50 we follow. All right. Now they're still positive. I'm not complaining. U.S. did great for 2 years. We think the second half of this year, U.S. is probably going to start to do a lot better, Caleb. And I think it's starting. I think it's going to continue.
Yeah. Let's look at this technical analysis. Beautiful chart here. The golden cross, when it works the other way, you know the market's in trouble. But we got a golden cross to the upside here with a 50-day moving average moving above the 200-day moving average. Break down the technicals for us. I love your charts, Ryan.
Yeah.
Why is this important? This is just a clear signal of momentum for a lot of people. But when we had the death cross, I think it was 6-8 months ago, things were not good at all. And now we have a death cross here with stocks moving to the upside.
Yeah, so a golden cross is simply when the faster
Golden cross, I should
50-day,
say.
yeah,
Sorry.
golden cross 50-day moving average moves above the slower trending 200-day moving average, and the death cross is the exact opposite. And that just happened last week, and you can see there you tend to get stronger returns. You tend to, if you're just purely following like trends, that tends to be when the best trends happen is when you're in this type of an environment. So it's just another kind of building block, I guess we'll say, for something that just happened that again suggests this likely the second half of this year, maybe even a little bit further, can continue to be positive as you tend to get better than average returns when you have this golden cross, which again we just had last week.
Yep. We got to love those indicators when they happen. And you say this all the time, and our friend JC says it all the time. When you get momentum signals like this, when you get sectors hitting all-time highs, when you get a lot of stocks, a lot of breadth with stocks moving to the upside, that is not a bearish sign. That is exactly what you want to see if you are a bullish investor and you're in it for the long term. And the trend is your friend, Khalif Fazal. You're absolutely right about that. So we do have better than expected earnings as well. You noted that in one of your recent reports, and folks will link to the Carson Group's Meteor Outlook that you and Sonis and your team put together. It's so good, so full of good information. We'll put that in the show notes. But the forward 12-month earnings per share is back to new highs, and the 2026 S&P 500 earnings per share is $300. Corporate profits moving higher when we thought they would be squeezed right now. Profit compression, that hasn't exactly happened, and companies now are guiding a little bit higher. What are you seeing?
No, you're right, Caleb. One thing fascinating, Sonu and I just did a call for advisors this morning, and he pointed this out, so it's fresh in my memory. At the start of the year, S&P 500 earnings were supposed to be up 13.3%. As of Thursday, expected to be up for the full year, 13.3%. Look at all the crazy stuff that's happened this year, all the negativity, all the worries, yet earnings are still the same as they were. And honestly, well, okay, if earnings are the same, why is that good? Because what was being priced in this time 3 months ago was a recession. Everybody's telling us how bad it was going to be. We avoided the comet one more time, and earnings have been solid. And, we've got earnings season right around the corner. It's crazy. I feel like we just had earnings season, but those financials kick it off here, I believe, next week. But the reality is corporate America is incredibly agile. I wouldn't want to bet against corporate America. Yes, someday we're going to have a recession. Someday we're going to have trouble. But, it takes a big event to kind of knock the economy off. And this is just another reminder that earnings drive long-term stock gains. I know you talked with Sam, I think, this last week. But when earnings are hitting all-time highs, it justifies this bull market. And this is why, again, we're hitting all-time highs.
Yeah, and that's why we invest. We are investing in those future profits, right? We are expecting companies to continue to grow their profits going forward. And basically, we haven't been disappointed except when we have these major events, right? Going into earnings season, which really kicks off into this week, but really next week as we get the financials and some of the bigger companies reporting. What are some of the key indicators you are watching from your perch at the Carson Group?
Well, from an earnings point of view, you're saying, or just in general?
Yeah. Earnings and also key things you're listening for from companies as they report the results.
Okay, understood. So I think the listenings we'll go that route here. How much of the potential prices are companies going to eat? Are they going to push back on profit margins? Profit margins, like we said, at the start of this year were the highest this cycle, right? And now so companies have a little bit of room to kind of eat potentially higher prices with tariffs. Are they going to? Are they not going to? And of course, some of the obvious one, how's the consumer doing? I mean, we know the housing market is really struggling. We understand why, because rates are so high and it's really hurt this housing market. The consumer, are there some cracks? Yes, there are some cracks. But overall, the stuff that we look at balance sheets, right? I mean, balance sheets of households and corporate America, Caleb, are in some of the best shape they've ever been in. And that's because, again, a lot of people own houses, a lot of people own stocks. They've done very, very well. Yes, $1.2 trillion in credit card debt, 36 trillion, give or take, in government debt. I'm not really going to go that route. What I'm going to say about on the debt that we see in our country from a household point of view, you can't forget the equity part of it, right? They call it denominator blindness. You got to remember the denominator. There's a lot of wealth out there, and if we have a slowdown, I don't say we're going to have a recession the second half of this year. We don't think we will, but balance sheets truly are in really good shape right now, and that's an important thing to remember. So be interested to actually answer your question now. We'll see what the companies say about the consumer. We think they're going to be pretty positive still, though.
Yeah, we continue to spend, and we've actually had wage increases, but
Yeah.
we'll see if things continue to either get better, or if we get a tariff shock in the next few weeks. That's going to be pretty important to watch. Question. We're going to get to you in a sec, Shivam, how the big beautiful will shape the future of international tax policy and global business operations. That we can't answer at this moment in time, but good question there. We'll get back to you on that. All right, Ryan, we know that you're I wouldn't call you a perma bull, but you are bullish right now, and you've been bearish at the right times and hesitant at the right times. But right now, given that we're kind of dancing around all-time highs, we have a lot of trends in our favor. What, if anything, worries Ryan Dietrich?
Mm-hmm. Oh, that's a good one. I think the reality is, what if there's a Fed policy mistake? I mean, call it the F word, right? The Fed. We've been in the camp, Caleb. The Fed should have been cutting this whole year. They should have been cutting earlier this year. Inflation's not really been a problem. We understand Jerome Powell's kind of a little wishy-washy with tariffs. He even said 2 weeks ago I would have cut 2 times if not for the tariffs. So I think a Fed policy mistake, aka the Fed doesn't cut going forward. We know they're not going to cut in July now, but I really think they should be cutting in September and a couple times later. If they don't, that could be a little stubborn. I mean, Powell obviously was late, hiking rates the first time. We think he's kind of late now cutting rates on the other end of this. So there's still time for it, but that's the one thing that gets me. But at the end of the day, 2 things I always follow. Make this quick. I know we're getting toward the end. Advanced decline lines and credit markets, right? Advanced decline lines hitting all-time highs across the board. That's broad-based breadth. That's what we talked about. And the credit markets, which were never saying the end of the world was coming back in April and everyone promised it to us, the credit markets are calm. So new highs in advanced decline lines, credit markets solid. Those to me are 2 things I always follow and investors should follow. Easy to follow those, and they're still pretty optimistic the second half of this year is going to be a good one for investors.
Great points. I know you follow those, and we should be following you, folks. If you're not already following Ryan Dietrich at the Carson Group, make sure he is on all platforms sharing the good knowledge. Check out the Mid-Year Outlook and your terrific podcast with Sonu. Facts and feelings.
Facts versus feelings. Yeah.
Facts versus feelings. That's where you guys spell it out so cleanly. Such good research. Love having you on the program and love your research, Ryan. Thanks so much for joining the Express live from the Stock Exchange. Good to have you here, my friend.
A huge fan. Thank you so much, Caleb. Listen to this every week, and it's an honor to be part of it. And it's awesome you're in the NYSE doing this now. So that's great. So thank you.
Thank you, man. See you this week. All right, let's get into some money in motion, because money has been moving at an intense velocity, and it's been moving into some interesting areas. Let's get into this Bitcoin buying bonanza that we have seen among corporate treasuries, really so far this year, but really dating back about 1 or 2 years. The corporations are scooping up Bitcoin and adding it to their treasuries. Now, why would they do that? Well, they want a little bit of hedge against the dollar for one reason, but also if they're adding Bitcoin to their treasuries, into their treasuries, and the price of Bitcoin rises, well, the value of their treasuries rises too, gives them a little bit more breathing room. So got some terrific research this weekend. Found a story on Bloomberg saying public companies increased their Bitcoin holdings by 18% in the second quarter. Bitcoin Treasuries is the source on this one. Here's some of the companies that have been binging on Bitcoin. BlackRock now owns $78 billion worth of Bitcoin. This is one of the largest money managers out there, running everything from index funds to ETFs, managing a lot of our money with over $12 trillion in assets. Well, they have been stuffing their treasuries with Bitcoin. $78 billion worth. MicroStrategy, everybody's heard of this. Really, the company calls itself Strategy now because it's basically a Bitcoin treasury. It's got $6.3 billion worth. Doesn't do much. And the CEO has been a Bitcoin bull since Bitcoin was invented. Mar Holdings, another big holder, $544 million. And GameStop did a debt, I believe it was a debt offering so they could buy $500 million worth of Bitcoin. Not your video game retailer anymore, but it's very interesting that you have these institutions and these public companies buying Bitcoin out on the open market and putting it in their treasuries, and individual investors like us either buying Bitcoin through the exchanges or Ethereum, but also buying Bitcoin ETFs. And Bitcoin ETFs spurred a huge rally in Bitcoin because retail investors could now buy a proxy to Bitcoin via ETF. We wouldn't own the coin, We would own an exchange traded fund that tracked the price of Bitcoin. There's nothing like the accumulation going on among public companies right now when it comes to Bitcoin. They want to own as much as they can. Right now, they own about 8 or 9% of the total Bitcoin out there. But don't forget this, there will only be some 21 million Bitcoin ever mined. We're right at about 19 and a half million right now. So these public companies want to make sure that they have their share of Bitcoin going forward to in case that price keeps rising. And if you listen to the Bitcoin bulls out there, the price, as far as they're concerned, is going nowhere but higher. And we see some legislation right now that's opening the doors for Bitcoin and stable coins and the tokenization of assets. Robinhood makes And we're back just like that. Wouldn't be a Monday morning in July without a technology issue, but we're back in business here. Uh, Live from the New York Stock Exchange. Big thanks to our buddy Ryan Dietrich for joining us there. I was just getting into this segment talking about the pros versus the Joes. Out there in Wall Street, they like to call retail investors like us dumb money. We're not dumb, we're just small. But I like to look at the difference between what retail investors are doing versus what institutional investors are doing to see what the discrepancies are. Because institutions, well, they're paid to manage money for people like us, and they can't make mistakes and they can't be wrong, but sometimes they're a little too cautious. And we know that institutional investors, according to the global fund manager surveys from places like Bank of America Securities, told us that institutional investors were much more cautious, much more fearful over the last few months, and may have missed a lot of the upside to this rally. So I took a look at what stocks individual investors like us, the Joes, have been buying versus what the institutional investors like them have been buying. There's some crossover here. The top retail stock purchases by the Joes like us: Tesla, Nvidia, Apple, Palantir, and AMD. And if you look at the top holdings of individual investors like us, it looks a lot like that. This data, of course, from Vanda Research, they put out tremendous information on what individual investors are buying outside of our 401k and defined contribution plans. What about the pros? What have they been buying lately? Let's take a look at that. A lot of the same stocks, but not exactly the same. Microsoft at the top of their list, Nvidia at another record high at the top of everyone's list, Amazon at the top of their list as well. And then you have ticker LRCX. That is Lam Research, do a lot of research around the semiconductor space, and then Lilly, the big drug maker. So some crossover there, but when you look at the difference, you see retail investors, the Joes, buying a lot of the momentum stocks, buying a lot on the dip, taking a few more chances because we're not managing other people's money. We're managing our own and trying to make a profit there. So we're going to take a look at this pretty often. The pros versus the Joes. What's the difference between what we're doing and what the big institutions are doing, and what can we learn from it? All right, let's look forward to the rest of this really busy week. One of the most important weeks in the capital markets heading our way. What to expect in this very busy week ahead, coming right up, right down the rail. All right, today, no big economic announcements, no big reports due today. Earnings season really kicks off at the end of this week, really next week. So today is a day to gather our breath. Stocks coming off record highs there. But going into Tuesday, Amazon Prime Day begins. It's not one day anymore. It's more like 3 or 4 days. That actually ends at the end of the week. We'll get a report on consumer credit tomorrow as well. And then Wednesday's the big day, July 9th. Circle the calendar in a big red pen. That's the deadline for reciprocal tariffs. We did hear from the White House and the Treasury Secretary yesterday that they will be placing 10% tariffs across the boards on countries that have not come to the table to make a deal. I don't know if that includes China. We will find out in the coming days. Thursday, we get the beginning of earnings season with Delta and ConAgra reporting results. We're going to find out what that vibe is from the consumer, as Ryan was talking about. How are consumers feeling? Delta will give us a pretty good snapshot on discretionary travel, one of the biggest airlines out there in the world, one of the best performing stocks last year, actually. And on Friday, we get a budget update for the month of June and the end of Amazon Prime Day. But everything is pointing to Wednesday this week because that is the reciprocal tariff deadline. We're going to keep a super close eye on, an ear on that, because that has been moving markets back at record highs because of the enthusiasm going into July 9th. Lately, been a little bit softer, a little bit tougher talk from the White House, given the fact that we are so close to the deadline. Let's talk about the Investopedia indicator of the week. We had a really solid jobs report for the month of June. 147,000 jobs were added, and the unemployment rate dropping to 4.1%. A lot of that due to the fact that there are less people looking for work due to the immigration crackdown, but because the jobs gains have been pretty strong, I guess, for the last 12 months, averaging about 146,000. The unemployment rate has been pretty low, and the labor market has been resilient. I want to look at revenue and headcount, revenue per employee. And this very smart chart here from Live Data Technologies talks about what companies have actually been reducing their headcount over the last 5 years. We hear the monthly job gains, month in, month out from the non-farm payrolls report. But when you zoom way out and you look big picture and what the biggest companies are doing in terms of their headcount, well, they're getting smaller. They are slimming their headcounts down. Why? Because it's more profitable. They're more productive with technologies like AI, right? They've better systems in place so they can operate with fewer employees. So when you look at the companies that have the highest revenue growth versus their actual headcount, we're talking about some of the biggest companies in the market that have been driving the gains. We're talking about, of course, Google, which is Alphabet, Netflix, Microsoft, Amazon, Oracle. And when you look at the overall big tech giants, revenue per employee, Apple leads the way with $2.38 million in sales per employee. You wonder why Apple's been one of the best performing stocks of the last 25 years? Well, they're getting more out of their employees, $2.38 million per employee. Meta Platforms follows with $2.19 million per employee. NVIDIA, they get about $2 million per employee. Why are they so profitable? Doing it with less people. And this is a trend we're going to watch going forward. So as we go into earnings season, which really starts the end of this week and into next week, pay close attention to headcount. We did hear from Microsoft that it had some layoffs last week. We're probably going to hear that more and more as companies right size and they get more profitable through the use of technology. See what that means to headcount and the overall labor picture in this country, which has been so resilient. Keep our eyes on revenue per employee, and we're going to keep our eyes on the tracks this week because it is a very, very busy week ahead, as we said. Pay attention to what's going on Investopedia.com. Our news team is all over it. Follow us on our social channels. This podcast, minus a little interruption there, is going to be available on all streaming platforms just a little while today. Thank you so much for joining the Express. Big thanks to our friend Ryan Dietrich from the Carson Group for coming aboard the Express as well. And we will talk again a little further on down the line.